And here's the part almost nobody understands until it's too late. When a system is built on leverage, time becomes leverage too. And weekends are where time turns toxic. Because while markets close, risk does not. Inside clearinghouses, calculations don't stop on Friday afternoon. They keep running. Every open derivative contract is remarked to market. Every short position is repriced. Every counterparty exposure is reevaluated as if liquidation could happen at any moment. And when a critical level like $67 is crossed, the models don't say, let's wait until Monday. They say this exposure is now unacceptable. That's when variation margin calls are generated, not emails, not warnings, obligations. Cash must be posted, collateral must be delivered. And if it isn't, the system prepares to seize positions automatically at the next available opening. But here's the paradox. The very moment banks need liquidity most, liquidity is least available. This is where the illusion of stability breaks, because people assume banks are liquid by default. They're not. They're solvent on paper and liquid only when markets cooperate. Banks don't hold piles of idle cash. They hold assets, treasuries, mortgage securities, corporate bonds, positions that can be liquid, but only when markets are open and functioning. On a Friday night, those assets are frozen in time, and frozen assets can't satisfy a margin call. So what happens next isn't panic, it's triage. Risk managers start asking brutal questions. Which positions can we unwind first? Which counterparties can we pressure? Which obligations must be met immediately to prevent a cascading default? Because one missed margin call doesn't just hurt one bank, it ripples. Clearinghouses are designed to protect the system by isolating failure. But when multiple large players face the same trigger at the same time, isolation becomes impossible. Everyone is connected. Everyone is exposed. Everyone is suddenly watching everyone else. This is how confidence dies, not publicly, internally. One institution starts wondering if another institution will survive the weekend. Then funding desks get cautious. Then credit lines tighten. Then repo rates spike quietly. And by the time markets reopen on Monday, the damage has already metastasized. The public just hasn't been told yet. Here's the uncomfortable truth. Banking crises don't begin with customers withdrawing money. Customers withdraw money after the system has already broken. The break happens upstream, in derivatives, in collateral chains, in overnight funding agreements written with the assumption that markets are always there to save you. But markets don't exist on weekends, only obligations do. Now think about silver again, not as an investment, as a stress test. Silver sits at a strange intersection. It's small enough to be volatile, but embedded deeply enough in derivative books to matter. It's hedged, rehedged, leveraged, releveraged, used as collateral, used as exposure offset, used as a safe short, because it wasn't supposed to move like that. And when something that wasn't supposed to move suddenly does, models fail. Not because they're stupid, but because they were optimized for a world that no longer exists. That's why certain price levels act like fault lines. Nothing happens, nothing happens, nothing happens. Then suddenly everything happens at once, because the system doesn't bend smoothly. It snaps discreetly, threshold by threshold, contract by contract. And this is where people ask the wrong question. They ask, why didn't regulators stop this? But regulators didn't build these triggers to cause crises. They built them to prevent unlimited losses. The kill switch exists so one bad bet doesn't wipe out the entire institution. But when many institutions share similar exposures, when leverage is systemic, when risk is crowded, the kill switch fires everywhere at once, and suddenly, the safeguard becomes the accelerant. This has happened before. Not always with silver, sometimes with currencies, sometimes with bonds, sometimes with interest rate derivatives. The pattern is always the same. A calm surface, a sudden threshold breach, a quiet weekend, then a Monday morning where nothing works the way it did before. And this is why timing matters more than headlines. A dramatic news event on a Wednesday gives the system time to absorb shock. A silent price move on a Friday denies it that luxury. By the time anyone can act publicly, the private damage is already locked in. Losses are crystallized, trust is fractured, liquidity is impaired. Ask yourself something important. If banks are so stable, why do they fear weekends during periods of stress? Why do emergency meetings always happen late Friday? Why do temporary facilities always appear on Sundays? Because everyone knows the same truth. If you can survive the weekend, you might survive the crisis. If you can't, Monday just makes it visible. This is why understanding structure matters more than predictions. You don't need to know what will trigger the next crisis. You need to understand how crises propagate through leverage, through timing, through contracts that don't care about intent or reputation, only settlement. And here's the final uncomfortable realization. Your money moves through this system every single day. Your deposits, your payroll, your card payments, your retirement allocations, they are not outside the system. They are inside it, which means when stress appears, it doesn't ask who deserves protection. It tests everything equally. That doesn't mean collapse is inevitable. It means fragility exists, and fragility punishes ignorance faster than it punishes risk. The people who are blindsided aren't reckless. They're uninformed. They assume normalcy is guaranteed. They assume Monday always fixes Friday, until one day it doesn't. So the real question isn't whether silver will ever hit $67. The real question is, if a mechanical trigger ever fires late on a Friday, would you understand what's happening while others are still confused? Because awareness is not fear, it's leverage. And in a system built on leverage, the people who survive are the ones who understand where the pressure points are before they're tested. Remember this, crises don't announce themselves. They execute. Quietly, automatically, and always at the worst possible time. If you want to stay ahead of that reality, you don't watch the news. You watch the structure. And this is where your decision matters. Because information like this is only powerful before the trigger fires. Afterward, it's just an explanation. So here's the line in the sand. If you want to understand how financial systems actually break, not how they're marketed, if you want early awareness instead of late explanations, if you want to see stress before it shows up at your local branch, then don't wait until Monday. Subscribe now, because this channel isn't about reacting to chaos. It's about reading the warning signs while there's still time to act. Share this with someone who still believes banking crises start with panic instead of contracts. Someone who thinks markets close on Fridays, but risk doesn't. And most importantly, take action today. Review where your money sits. Question how much of your wealth depends on leverage you don't control. Build flexibility while others assume stability is permanent. Because when mechanical triggers fire, there are no second chances. There is only preparation or explanation after the fact. Choose preparation. Stay informed. Stay ahead.